Well, it's a big day for the Chinese economy this Tuesday. The numbers for 2014 and the fourth quarter were released this morning. The data shows that the Chinese economy remains under pressure, and our reporter Yang Chengxi has been tracking the figures for us and is here to give us the breakdown. So, headline number slowing down, Chengxi, but
China's economy is in a new normal, and the annual economic data from 2014 is supporting the fact that the world's second biggest economy is entering an era of slower growth. China's overall GDP growth rate for 2014 slowed to 7.4%, which marks the slowest pace of expansion since the year 1990.
Global recovery is still slow. In China, economic growth rate is shifting gear to a lower range. Structural reforms are deepening. Also, the country is digesting the effects of previous stimulus policies. All these factors contributed to downward pressures on our economy in 2014.
In terms of what slowed it down, we know investment, real estate, they struggled last year because they're credit and policy dependent. We know that export markets were struggling, so exports battled. And consumption is still too small as a share of the overall economy to push it forward.
However, China's policymakers have said the country is aiming to move beyond just meeting targets, and they plan to make 2015 a year of reform, sacrificing some of the growth speed in exchange for a better quality growth model. New data shows that general direction. The service sector accounted for almost half of GDP last year, and domestic consumption growth, for the first time, surpassed the speed of GDP expansion.
So we do hope that there's be a continuing rebalancing of that growth, hopefully a bit less investment growth, more consumption growth, and also a bit more growth in sectors that are the future. If you want the services growth and the higher tech manufacturing growth that have more value added, that's the future for China, and reforms that support that, and we've seen some of them last year, they're very important for the future health of growth in China.
And that's the right move. We need to see the reliance of the economy on credit field investment decline. We need to see the economy delever. We need to see the absorption of non-performing loans. We need to see some kind of digesting of the overcapacity in the industrial sector.
Still, in the face of downward pressure on China's economy, most financial institutions believe the government will roll out more stimulus measures early this year. Since China's fiscal policy is already in a proactive mood, analysts say that the room to maneuver will likely to be in the area of monetary policy.
You've got falling commodity prices, you've got slowing economic growth domestically, you've got overcapacity in the industrial sector, and really that gives you space to cut the reserve requirement ratio and cut interest rates. And that we expect to see over the next couple of months.
All these factors show that the government's economic task in 2015 will be more challenging in this economic new normal. Analysts say that 2014's data shows that China's traditional growth model is already becoming unsustainable. That's why since last year, policymakers often stress that the measures implemented in 2015 would be about balancing expansion with structural reforms and also finding new growth points. Yang Chengxi, CCTV, Beijing.
a tough balancing act as always.